Welcome to the FAD videocast. In this episode, we share the opening remarks from Vitor Gaspar, the director of the Fiscal Affairs Department during the first webinar about the VAT. The International Monetary Fund and the Revenue Mobilization Thematic Fund launched a series of 4 webinars covering different aspects of the VAT. Following the opening remarks by Michael Keane, the Deputy Director delivers a presentation about the VAT over the last 20 years.
Honorable Minister of Finance, Heads of Revenue Administration, ladies and gentlemen, welcome. Good morning to you all, or good afternoon, or good evening. I'm extremely pleased that now we have 250 participants online for this FAD RMTF webinar on the VAT. This webinar is the first of 4 webinars on VAT that we'll be organizing in the next 6 months. I am pleased to see so many of our fund members and partners represented here today as we look back on the world's experience on VAT in the last 20 years. What have we learned? How does this take us forward? It is certainly a big topic, and I want to thank all officials, presenters, and other interested partners for taking the time to prepare for and join this webinar despite your very busy schedule in these strange times. I would also like to extend FAD's appreciation to the members of the Resource Mobilization Thematic Fund, RMTF, for making these webinars possible through their generous financing. So let me first take a step back and attempt to phrase today's broader global context for revenue mobilization as we prepare to dive deeper into our discussion on VAT. VAT is a game changer. Originally, it was introduced in France in 1954. The concept was pushed by an inspecteur des finances, Maurice Lauré. It has now been adopted in most of the world. It is a strong workhorse to generate tax revenue. Coupled with the destination principle, it is robust when applied internationally. The IMF has played a worldwide leading role in helping countries adopt VAT and exploiting its reform catalyst capabilities. And with this in mind, today, we will still find ourselves in a world where many countries need to restore revenues sharply reduced by COVID-19. And these countries should take a medium-term outlook so as to generate a revenue base compatible with the achievement of the Sustainable Development Goals. Our studies pre-COVID showed that the additional spending required for meaningful progress on the SDGs in these areas by 2030 is quite large. In emerging market countries, additional spending every year reaches about 4 percentage points of GDP in 2030, while for low-income countries, the corresponding figure is 15% of their GDP. So, questions. How can policymakers balance large financing needs, including to meet the SDGs, and support inclusive growth, and at the same time, keep debt sustainability? The need to build tax capacity is at the center of any viable financing strategy. This brings me back to the subject of today's and the forthcoming webinars on the VAT. As I have already said, in most countries, the VAT has been the workhorse of budgets, and this will continue to be the case in the foreseeable future. But in many countries, there remain controversies and difficulties related to the design of the VAT, its incidence, and difficulties in managing VAT compliance effectively. Moreover, in many countries, there remains a large gap between actual VAT revenue and the revenue that would be expected with full compliance. Closing this gap offers the prospect of significant additional revenue. We estimate it to be up to 3.5% of GDP if LIDCs in the lower quartile by C efficiency were to raise it to the LIDC median. Today's webinar will provide us with an excellent opportunity to share lessons learned over the last 20 years in areas of VAT policy, administration, and legislation, and how these lessons can be leveraged to help countries further improve the efficiency and effectiveness of the VAT. We hope that this webinar will be interactive, lively, peer-to-peer discussion covering these issues and other important ones as well. We want to take advantage of the knowledge and different points of view of all the policymakers and practitioners attending this webinar. In closing, I would again like to welcome all of you to this important webinar and express my hope that you will contribute actively by sharing your country experience and your expertise and track record as policymakers. All the luck and all success with the webinar. Thank you.
And welcome everybody. Yes, it's quite a tall order that I've been given to cover in 20 minutes. So let me make a start and let me go back a little bit even beyond the 20 years. Let's go back to the very beginning of the VAT, which the claim to have invented the VAT is disputed. But today, at least, I'm going to award it to the German businessman, Friedrich von Siemens, in the early 19th century. As Vitor says, Maurice Lauré, as Le Père de la TVA, often is associated with driving the VAT. Perhaps the credit for inventing it, which is slightly disputed, goes to the gentleman on the left. And so what do we mean by a VAT, starting with the basics? Well, what I have in mind with the VAT is essentially a tax that's charged on all sales by businesses, but at the same time, those businesses get a credit or a refund of the tax that they've been charged on their own purchases. Now, that must have seemed kind of a pretty crazy idea, I think, when this was first invented. You're going to raise all this money and essentially give a lot of it back. But as we've come to learn, I think there's basically a great deal of cleverness in this idea. And two key elements of the cleverness, I think. One is that the VAT, because of the crediting and the refund, in principle should not stick on businesses' input choices. It shouldn't matter for them because they're going to get the money back in some form. So we're not going to interfere with business decisions on input choices, which is different, for example, from a turnover tax levied on all sales but without any credit or refund. At the same time, the second clever bit is that revenue is protected more than it is, for example, under a retail sales tax. If you simply levy a tax at the final point of sale, well, if you miss tax at that point, you're left with nothing. Under a VAT, you're at least left with the revenue that was collected on the purchases of that retailer. Or more generally, you may collect the VAT later on in the chain. So there are these two kind of key advantages inherent in the idea of the VAT. But of course, that presumes that everything works well. And I think we're all here because the VAT becomes a challenge when things don't work so well as these simple ideas might suggest. Nonetheless, I think it's good to begin with just reminding ourselves how remarkable the rise of the value-added tax has been. In little more than 50 years, revenue collected by the VAT has risen from basically nothing to, we reckon, about 30% or so of all the world's tax revenue, which is kind of pretty stunning. And I think one of the reasons we're so keen to have this series of events is to remind ourselves that we often get concerned with other tax issues that are interesting and important, but really the workhorse, as Vitor says, of revenue systems has become the VAT. And that, I think we can clearly see is the way the world is going to go as well. So speaking of the rise of the VAT, just to chart what's actually happened, if we look at how things have developed over time, we had the early adoption going on in the higher income countries. We had this sort of phase beginning in the 70s with the European Union, pick up thereafter. We have the upper middle income group following along a little bit later, lower middle income, with a really remarkable rise of the VAT starting in the 90s. This was really when, and I think the IMF was largely behind all this, was certainly encouraging this trend of the recognition that the VAT could work not just in high income countries, but in lower income countries too. And then we have the low income countries coming on still more recently. And we end up then with more or less 160 countries having something like a VAT. Now I say something like a VAT because that little chart kind of implies that, you either have a VAT or you don't. But importantly, VATs differ quite widely amongst themselves in a variety of ways. Two very simple ways in which they differ are shown here. They differ in the number of non-zero rates countries have. So on the left, interestingly, you can see that there tend to be more non-zero rates in the higher income countries. And there's even more divergence on the right-hand side when we think about the VAT threshold, which is a key parameter of the value-added tax, and one that I know we focused on a lot in our work. See how much variation there is in that relative to GDP per capita across the different income groups. And that's kind of interesting, I think, because there's a question of, well, is that really reflecting something about the economic circumstances of these countries? Or is it that we don't really have such clear guidance on where the VAT threshold should be, as we may have on other elements of the tax system? So these are just two dimensions along which VATs differ. There are many others in which they differ in their range of exemptions, how they treat, the way the refunds work on exports, any restrictions there may be on that, so on and so forth. But we should recognize the VATs differ quite widely, very widely. Of course, we might wonder, well, has the VAT done its job? Part of the job, of course, is raising revenue. And I think, going from 0 to 30% of the world's revenue gives us an answer of yes in terms of the revenue raising. But there are other things we should worry about as well. So we should worry, well, has the VAT actually proved a particularly efficient source of tax? Has all these claims that it's good for business work? Are they in terms of not distorting investment decisions? Do we have some kind of evidence that's the case? Well, one way of looking at that, and to answer the revenue question more generally, is to ask, well, do countries that have a VAT raise more revenue than countries that otherwise look the same but don't have a VAT? So does having a VAT conditional and everything else tend to be associated with higher revenue, which would suggest that it's actually also been a tool that governments find an efficient way to raise revenue? I think empirically the answer to that question is yes. There is evidence of this efficiency of the tax. Less clear, I think, in sub-Saharan Africa when we do it by region, but the results on that differ, but there's a little question mark there. We can ask too, well, if the VAT, well, let's not say it's necessarily good for growth, but is it less bad for growth than other taxes? And I think there again, the answer is yes. But some of the work that colleagues at the fund have done have reminded us that in that context, actually, it's not just having a VAT, but it's the design of the VAT matters. So for example, if you want to raise VAT revenue, there's some evidence that in terms of the growth impact, it's better to do that by broadening the base than it is by raising the standard rate. So design of the VAT matters when we think about these issues of growth and efficiency. I want to say a little bit about one tool that I think can be very helpful in thinking about diagnosing the performance of VAT, and that's what we call C efficiency, sometimes also referred to as the Vac Revenue Ratio. What is this? Well, simply what you do, you take the actual revenue that the VAT collects and you divide it by the standard rate of the VAT multiplied by aggregate consumption. Why is that so interesting? Well, what you're doing in the lower part of that exercise, in the denominator, is you're figuring out what revenue you would raise if you applied the standard rate to all final consumption, to all consumption. And that's the revenue you'd raise from a kind of ideal single rate VAT applied with perfect enforcement. So if you get a number of 100% for C efficiency, that's pretty good. That's what a perfect VAT, perfect in the sense of a single rate, perfectly enforced, that's what the perfect VAT would raise. It's also possible, by the way, for a very bad VAT to get a good C efficiency score, for example, if you don't give VAT refunds. And I think it also gives one other value of this, and illustrating the value, one exercise one could do with this is to get a sense of the revenue potential of the VAT. And this is the kind of exercise Vitor referred to, where if you take, for example, the low-income developing countries that are in the bottom 25% in terms of their C efficiency, How much revenue would they raise if they went from C efficiency not to 100%, but just to the median, just to the middle that that low-income group had achieved? Well, they'd get about 3.5% of GDP, which is a lot. So a kind of reasonable aspiration in improving C efficiency can have a substantial revenue gain. We see on the right, this simply shows trends in C efficiency by income group. You can see how this has been trending up, and perhaps not surprisingly, tends to be higher in high-income economies. Here's another kind of use of the idea of C efficiency, which is to figure out, understand what's happening to your VAT revenue. So let's take, for example, let's think, here we show developments in VAT revenue by income group of country over the last 10 years for which you have data. Here's the total change in VAT relative to GDP. Okay, so it's gone up, but where has that increase come from? It could come from a variety of things. It could come simply because consumption has gone up as a proportion of GDP. And so that's how much of that total increase in the blue diamonds would be accounted for by that. So you can see in upper middle income countries, that pretty much explains what's happened to the VAT. In low income countries, on the other hand, it actually makes raising the developments have actually made raising VAT revenue more difficult. Another source is the one we just looked at, C efficiency. And there what stands out is for the lower income groups, that's where a lot of the additional revenues come from improvements in C efficiency, which we would tend to say has been signals some improvement in the effectiveness of the tax. And then the rest comes, from increases in the standard rate. You can see how that also differs across the country. So here's a nice use of C efficiency in understanding what's happened to VAT revenue. One can also think about using the C efficiency. Well, when you think of C efficiency, you want to say, well, why is this number not 100%? Where does the difference from 100% come from? And analytically, you can divide the shortfall of C efficiency from 100% into two terms. One reflects compliance, and that's essentially, as Vitor mentioned, the gap that essentially reflects the additional revenue you would raise if the current VAT was perfectly enforced. So that's the compliance gap. And then there's a policy gap, which is the additional revenue you'd raise if the tax were perfectly enforced, if you were to tax all consumption at the standard rate. And on the right, we illustrate the kind of decomposition one can do, where you can see, for example, in the high-income countries, the issue tends to be a policy gap. Lower-income countries, there's a little bit of both. So here's how one might think about diagnosing the performance of the VAT, and by delving deeper into these, where the compliance and policy gaps come from, improving its performance. I can't really avoid saying a little bit about something I know we'll say more about, the question of the distributional impact of the VAT. Of course, the concern with many that the VAT is a regressive tax. I think that's an argument many of us would tend to be rather skeptical about, at least to begin with the observation that, well, it may be true that by setting reduced rates on basic items, you support the poor in the sense that they spend a larger proportion of their income on these items. And that's what you see in the chart on the blue bars in the chart on the right, just for Sri Lanka. We could choose many countries for this. You can see that the proportion of income spent on these items decreases with income. On the other hand, the rich tend to spend absolutely more on these things. So that means the lion's share of the cash that is forgone as a consequence of these preferential rates goes to the better off. And that's what you see in the red line. So the question becomes, well, whether countries have better targeted tax instruments or spending instruments in particular to help the poor. And I think increasingly around the world there are. And I think even during the recent pandemic, we've seen developments in this area, countries' ability to target support, that really reinforce this case of thinking, well, is the VAT really the best way of doing these things? Could we not provide equivalent support and have a better revenue outcome? A couple of points, maybe I'll just point to the first one here, because I think one thing to bear in mind is we almost always assume that the VAT is fully passed on to consumers, that when the VAT goes up, prices to consumers go up by the same amount. That's not necessarily the case. Some of the burden may fall on wages or profits, or there are other ways that the burden might fall. There's more evidence these days on what actually happens in terms of the incidence of the VAT. And one thing that's emerging, I think, with, the evidence is, I wouldn't say it's overwhelming, but there is evidence there that actually, in particular, reduced rates, the benefit of reduced rates is not necessarily fully passed on to consumers. Some of it may remain with the businesses in some form or another. Now, there's a point to bear in mind when we think about distribution impact. And we need to recognize, too, that another issue that recent empirical work has shown us matters quite a lot is that the poor probably buy from smaller businesses in many countries, and those businesses may well not be registered for the VAT, so that the value added at the final stage at least is untaxed, and that again, it has some distributional advantages for the better off. So let me just conclude by mentioning some of the issues that I haven't really touched on. There's a whole bunch of old issues that have been around for a long time with the VAT. There are issues I'm sure we'll spend a lot of time on in this series of events, to do with non-compliance, refund fraud, inappropriate credits, and so on. But the thought I want to put in one's mind before we get into the detail is the real question is not whether there are problems of this kind with the VAT, but whether they're worse than with other tax instruments. And it's not clear, the evidence is not, there's very little evidence, but it's not at all clear to me, for example, that these problems are greater with the VAT than they are with the income tax. Other perennial issues include the treatment of the financial sector, the treatment of government, VAT and federations, where I think we've learned in recent years quite a lot about how VATs might work in federations, and we look forward to hearing more today. I know about the Indian experience on that. And then there are some kind of new or newish issues, how we deal with cross-border intangible services, how we deal with the new digital platforms. There are links too, I think, increasingly with corporate tax, because as you will know, the corporate tax debate is now recognizing potential taxing rights under the corporate tax for the market country, which VAT people would call the destination country. So quite where the corporate tax links in with the VAT is, I think, going to become an increasingly important issue as we move forward. Finally, of course, we know we're in a technologically changing world, and that's going to mean something for the VAT. We see some signs already in terms of how we implement the VAT as it is now. I think there are more fundamental questions about what the technology will allow us to do with the VAT. For example, if we had a real blockchain system that captured all transactions perfectly and in a readily monitorable way, then basically we wouldn't need a VAT at all, because those two advantages I mentioned at the outset, we wouldn't need them if we could monitor all transactions. So we could simply get rid of the VAT. So with that, let me apologize having sped through quite a lot of material, but let me hand back to you, Vicky. Thanks for your attention.
Mick, thank you very much. That was quick but amazingly thorough. And I can see already, looking at the Q&A, that you've generated a number of questions, which we'll turn to when we get to the Q&A portion of our program. So thanks for those, and keep those questions coming. And Mick, thank you so much. We're now going to turn to have some follow-up on Mick's introduction to our panel for the day, which we'll are fortunate to hear from before we get to the Q&A. From all of you. So our panelists, in the order in which they're going to speak, include Rebecca Miller, who's a professor of law at the University of Sydney in Australia at the law school. She teaches VAT, GST law subjects and the postgraduate tax program there. She's published extensively in the area of comparative analysis of design and application of GST VAT laws. And she also has a lot of experience assisting and advising countries in working on the design and drafting of their VAT laws. Second, we'll hear from Patrice Piet, who's the head of the unit for VAT in DG Taxud at the European Commission. And he's therefore responsible for the development of VAT policy. And notably, I think we'll hear much more about in the context of the recent tax action plan. Before that, he was head of the legal unit there. Then we have Indira Rajaraman, I'm sorry, who is from India with a PhD in economics from Cornell. She was previously professor of economics at the Indian Institute of Management and the Reserve Bank of India chair professor at the National Institute of Public Finance and Policy in India, in Delhi. And she's also been a member of advisory commissions to the government and served as a member of the 13th Finance Commission and on the central board of the directors of the Reserve Bank of India. She's going to speak to us about the Indian experience, which, as Mick alluded to, is an incredibly interesting one and an ongoing story. And lastly, we have Nicolas Yanusi, who's the Director General of the Benin Tax Administration since 2016. With extensive experience in VAT administration in Benin in various positions: head of the small business tax group, head of the medium-sized business group, and also modernization and change management, obviously a very key topic. So without further ado, I'm going to turn to Rebecca, who's going to address the question, what does the recent academic work in the area of VAT tell us about policy? And what are people focusing on? What questions are being focused on now? And what key proposals might be being made? So Rebecca, thanks very much for being with us, and I'll turn over to you. As we've discussed, you have 7 minutes. That's a lot to cover in 7 minutes, but thanks for trying. Rebecca, you're muted.
I got told to mute and now I forgot to unmute. Sorry about that. So I was saying thank you, Vicky, and thank you, Mick, for your presentation. So I have the unenviable task, or I thought my brief actually was to talk about what have academics been writing about for the last 20 years. So I'll just continue with what at least comparing what people were writing about 20 years ago with what they're writing about now. And I should clarify that I'm speaking as a legal academic, not an economist, which means that I can't put nice graphs up and just, show visually what people have been writing about. So I thought that I would actually just talk about 4 themes that are sort of consistently in the legal academic literature. And the interesting thing is that those themes have been relatively consistent for the whole of the last 20 years, but with shifts in emphasis as time moves on. So those themes are what I would call traditional VAT design concerns, the kind of thing Mick was talking about, the base, the rate, compliance, and so forth, and I'll come back to that. The second one is threats and risks to VAT, so avoidance, evasion, and complexity. And the third one and the fourth one I'll kind of join together, although they're not really one issue, which is international tax issues for VAT and the digitalization of the economy. So just thinking first about traditional VAT concerns, there's a reasonable body of work from lawyers on compliance and administration burdens, and in particular the issues facing small and micro businesses in complying with value-added taxes, and discussions there about the appropriateness of thresholds and how you determine where you should set your threshold if you're going to have one for a value-added tax. The usual VAT issues, how should we deal with intermediation services, so financial services, insurance, and gambling. And the general tone of the literature is that we should move further and further towards full taxation of intermediation services. Some countries like Australia, where I'm from, and New Zealand, where I was originally from, do already tax insurance and gambling. So there's some comparative work looking at how does that work in each of those countries, and could that, for instance, be adopted in the European Union or in some other country? And a lot of comparative work as well on the different approaches to taxing aspects of, but not all of, financial services. The treatment of government and the non-profit sector gets some coverage as well in the literature. And then there are the usual tax base arguments. And amongst lawyers, there are arguments both for and against what I would call the traditional IMF idea of the modern VAT, that is a broad-based, low-rate VAT, where any issues of regressivity are dealt with through other compensating measures not within the tax system. And probably the bulk of legal academics work from the presumption that the IMF idea of a modern VAT is what everybody should aspire to, but there is a small body of literature and growing in some areas, saying, well, that doesn't address political realities, it doesn't address the context, VAT in its context, and there are arguments in favour of exemptions and lower or zero rates for some basic items. So Mick will probably disagree with me later in the Q&A on that. So when it comes to discussing threats and risks, and this is an area where where traditional legal discourse really comes to the fore. A lot of what legal academics write about springs from case law. You know, what has case law revealed about a value-added tax? What inconsistencies has it created? What does it reveal about flaws in the design of either a particular law or the underlying policy of a VAT? And what a lot of this work reveals is that VAT is not in fact always a simple tax, because it's a transaction tax, and business transactions are sometimes extremely complex. We have this idea when we think about a VAT of a transaction chain. You know, somebody makes something, somebody wholesales it, somebody retails it, and then somebody buys it, and they're the consumer. But the reality, particularly in the modern world of many business transactions, is that there's a complex web of interactions between businesses and consumers, where it's not always easy to identify who is supplying what to whom and what's being paid for it. There's a lot of literature on VAT evasion and the appropriate responses to that. So I think that Patrice may talk about some of those, I'm not sure. But comparing different nations' responses, so domestic zero rating, exemption down the chain, reverse charges, partial withholding, split payment mechanisms, automation of payment so that you pay your VAT directly into an account that can only be used for value-added tax, and you pay the rest to the revenue authority. So there's a lot of work on that. And also on avoidance, which is obviously a slightly different issue, and on the kind of legal appropriateness of general anti-avoidance rules and how they fit with the rule of law, with constitutional law principles and so forth. I fear I'm already going to go over my time. Mick's second slide, and this relates to one of the questions that I see.
You have about 2 more minutes.
Okay, thank you. One of the questions that's popped up is about Mick's second slide, which said revenue is protected if the compliance chain breaks, and what does that mean? In very simple terms, it means that if a business doesn't pay their VAT, you've still received part of the VAT because all of their inputs have been taxed. So that's the theory. There's quite a lot of VAT literature about the ways in which evasion is used to deliberately break the chain, but also recover all of the input tax when you've broken the chain. So essentially carousel fraud schemes where you just have transactions going round and round in circles, generating more and more refunds from the Revenue Authority without any VAT ever being paid. And it turns out that they can happen almost anywhere, not just in old school VATs that have non-ideal structures. Also on Phoenix fraud, and there have been a number of changes, if anyone wants to ask about those, to the Australian New Zealand laws in response to Phoenix fraud. Then turning to the final 2 topics, which are international tax issues and the digitalization of the economy. Digitalization has really driven developments in the cross-border area as well, and particularly following the release of the OECD International VAT GST guidelines, there's been a flurry of countries around the world adopting new regimes, sort of simplified regimes, they call them, to involve non-resident suppliers and particular platforms in paying VAT to countries where they're not resident for services that are imported into those countries, and for the import of low-value goods that previously were not taxed. And there are people writing on both sides, in particular about the appropriateness of involving the platforms. How should they be involved? Should they be required to pay as if they're the supplier? Should they only be required to provide information? Should they be a backup? So there's a lot of disagreement about how that should work. And a lot of discussion about the lack of neutrality that results when there's not an equality between the treatment of domestic and foreign small suppliers. And then another area that is complex is the sharing and gig economies and the disruption that creates by creating millions of micro players who might or not meet the criteria for being considered a registrable business. So how should we respond to that? Should we change our notion of what is a business so that we can get all of those small people who are providing services through the sharing and gig economies? How do we achieve neutrality with traditional economic actors? And, you know, again, should we involve the platforms and just get the tax from them? And what does that mean for the multi-stage transaction tax? And then there's also, of course, discussion about things like cryptocurrencies and blockchain. And blockchain to me is like, unless I get a mathematics degree, I'm never going to understand it. So I think
well,
that's my 5 minutes.
Thank you, Rebecca. I think that presentation certainly helps us understand why we may say that the VAT is a relatively simple tax, and indeed, in some ways, it is a relatively simple tax, but perhaps this just goes to show that no tax in the modern world is really simple. And as Mick said, one has to ask what's the alternative. But that's certainly, Rebecca's talk certainly raised a lot of, at least for me, really interesting questions that I hope you will all follow up on. So I'll now turn to Patrice, who's going to talk to us about the EU experience with the VAT and perhaps especially recent developments in which he's been very much involved. So Patrice, I'll turn over to you, and you too have about 7 minutes. So thank you.
Thank you very much, Victoria, and thanks to the IMF for hosting this, this very interesting webinar. If you look at the European, the EU experience with VAT, I would structure my presentation first by stressing what have been the main challenges up to now, and then I will turn a little bit about to the next challenges, notably in the context of the recent tax action plan, which we have just published. Traditionally, so up to now, what have been the main challenges? Historically, European harmonization has mainly been driven by two factors: the need to set up a single market and the need to make VAT an EU own resource. It's been said by Vitor Gaspar in his introduction. VAT was first introduced in France, but it quickly became an EU tax. Already in the 60s, we had the first harmonization directives. So a need to set up a single market without any internal borders, no longer to collect VAT at internal borders. So we had the need to find a system to collect VAT in another way, which is not disruptive for international or intra-EU trade. And the second factor, the decision to have VAT as an EU own resource, for obvious reasons. If you want to use VAT as an own resource for the EU budget, you need to harmonize the tax base. So this is what has been done in the last 20, 30 years, 40 years, I would say. And we've reached a state of what I would call partial harmonization. Partial harmonization. We still have a transitional system of VAT. So we dismantled the collection of VAT at the borders, but we have kept the exemption on intra-community supplies, and we are taxing acquisitions. And there is an exchange of information between member states to make sure that this is not prone to fraud. Of course, the system is not perfect, and that's why we've recently proposed to remove this exemption and to tax through a one-stop shop, single place of registration, to tax in the member state of origin, but at the rate of the member state of destination, a proposal which is not yet adopted. Partial harmonization also from the point of view of VAT rates. We try to harmonize VAT rates, but unfortunately, we've been left a little bit in the middle of the road. It's only partial, not everything is harmonized. The system is extremely complex. And of course, it's highly political. So, so the logic behind the legal framework which you have today is largely inconsistent. And on top of that, it is not equal. It does not give equal rights to the different member states. That's why also here we made a proposal in 2018 to have a more structured and logical scheme for VAT rates, but unfortunately, this is yet not adopted by Council. And one of the main objectives was to give equal treatment and more leeway to member states. Of course, another challenge we have is the unanimity principle, because although VAT is largely in the competence of the EU, with the Commission making proposals, but member states adopting these proposals through Council, we have to get the unanimity of all member states, which makes the process extremely heavy. We've proposed to move to qualified majority voting, but unfortunately for the time being, there is no appetite for this. More recently, we've been faced with two additional challenges. VAT fraud is one. Rebecca has talked a lot about it. It's particularly true in the EU. We have fraud on intra-EU transactions estimated at around 50 billion euros per year, a VAT gap, last figure of 140 billion euros. So here we have worked a lot on strengthening cooperation between countries, and we've proposed an overhaul of the VAT system with this ambition to reduce fraud. And the second challenge has been the rise of electronic commerce. And there a lot of changes have been made over the last years in the EU. First, through a scheme where we tax non-resident suppliers of electronic services, providing their services to EU customers through a single place of registration called the one-stop shop. And this will be extended as of next year in July to supplies of goods. So all the parcels coming from third countries will be subject to taxation, whatever their value is in the EU, and there will be a scheme, a one-stop shop, in order to simplify compliance on this. There is also rules in order to collect VAT from the platforms, which will be put in place. Now let's look at the future. We've just published a recent tax action plan where many initiatives in the area of VAT are referred to. So for the time, from this perspective, the timing of this webinar is really the right one. This action plan aims both at simplifying tax rules to help businesses and therefore help rebuild our economy, but also fight fraud more efficiently to help member states collect and recover the money they need precisely for the recovery. So as far as VAT is concerned, we've proposed actions in these two pillars, simplifying EU VAT legislation. We've proposed reforms in a number of areas. Rebecca has mentioned VAT on financial services. This is an area where we will be working. We intend to make a proposal at the end of next year to review the current exemptions, to simplify the schemes and see how we can improve the competitiveness of our own financial sector. But also make our VAT system more fraud-proof through administrative cooperation, but also through digitization. And this brings me to another feature of the reforms of VAT, which we plan to propose, which is linked to digitization. How can we adapt VAT rules to new technologies, and also how can we take the benefit of the opportunities from these new technologies? So it's both a challenge, which forces us to rethink the way the VAT system works in the EU, but at the same time, it's an opportunity where we need to draw from new technologies the tools which can help fighting fraud. And there are just two examples of initiatives where we will be working on. We will, by 2022, review VAT rules which applies to the platform economy. The question is, who is taxable? There are lots of micro businesses involved there. Where do we need to tax, in which member state, and how? What is the role of a platform in collecting? So all this will be reviewed. And the second example I would give is how can we use technology to improve VAT reporting? We've not been very successful in changing completely the intra-EU VAT system, but we would like now to reflect on how to fight fraud in reviewing VAT reporting, making it real-time reporting, maybe through the use of electronic invoicing. There is a conference which for which I've just done the introductory presentation a few minutes ago, for 3 days, where our experts from tax administrations and businesses will reflect on the different tools we have. And at this stage, everything is open, including the issue of blockchain, which is also on the table in this context. So to conclude,
thanks.
If I may, I think I've exhausted the time. Indeed, to conclude, the EU is now at the crossroads. We have achieved a lot, but we still have many challenges. And this is hugely important because as Vitor and Michael have stressed, VAT is one of the main tax receipts in the EU. We can just not do without it. Thank you.
Thank you, Patrice. That was incredibly interesting and certainly raised a lot of issues that have been alluded to in the by the previous speakers. So now I want to turn to Indira, who is going to, as I noted, take us through what's happened with the Indian GST, which is incredibly interesting in that India is such a huge federal country that had a lot of kind of a patchwork of consumption taxes, one might say, at various levels. And she's going to not only shed light on what's happened, but on what I think what remains to be done, what problems are encountered in this sort of transformation. So Indira, thank you. Over to you.
Thank you, Victoria. Can I be heard? Can I be heard? Yes. You promised to give me a 1-minute warning before my 7-minute limit is up. Yes, okay, because I'm not keeping time over here, so yeah. Thank you very much. The big development in India over the last 20 years, in fact, one might say the last 70 years of the existence of the Indian Federal Republic, was the introduction in July 2017 of a national value-added goods and services tax. The reason it doesn't have value added in its name, it's referred to as the GST, is because the main significance of this tax was the merger of goods and services in a single value chain in India. Because previously in India's federal constitution, taxation of goods lived separately in a separate tax domain from taxation of services. So the merger of goods and services was a major achievement, and therefore the GST highlights, the name the GST highlights that achievement. Prior to that, the value-added principle had already been being applied in the separate domains in which goods and services were being taxed, but now they were all merged into one. So it was a major political achievement. That said, the GST in India has run into a lot of trouble. And it has suffered from design defects and from the difficulty of carrying a tax with agreement between what are now 28 states. Previously, we had 29 states, and the central government, the national government, which we call the central government. So getting them all onto the same page and agreeing, just as Patrice just told us in the case of the European Union, is difficult. Even though this is within a country, yet it's a federal country and getting agreement is difficult. Since I have very limited time, I'm not going to put up any graphs, even though, as Rebecca said, as an economist, I could put up a graph or two. But I'm going to save time by just speaking, and if there are any questions, I'll be happy to put up some graphs. I want to focus on two very important lessons to learn from the Indian experience, a federal country with a lot of very, very poor people and small businesses in it. The first lesson is this. The GST was introduced in India in a state of very high revenue anxiety on the part of both the central government and the state governments. There was anxiety about revenue. Now, why there was this anxiety, I'm not going to go into. But there was a great need to get it off to a very good revenue start. And as Mick Keane said in slide 4 of his presentation, the good way to do that was to expand the base and not hike up the rates. So that is what the Indian GST tried to do. However, in the initial design, the way this was done was in a very coercive way. The compliance architecture setup was very, very demanding, and all taxable entities which were within the net were asked to supply excruciating detail on all the businesses to whom they had sold downstream and all the businesses from whom they had bought upstream. And the idea was to coerce businesses already within the tax net to have transactional dealings only with businesses which were above the registration threshold, whether it was, as I said, downstream or upstream. Now, India is a country with very many small businesses legitimately below the taxation threshold. And small business in India, which in many ways is the backbone of the Indian economy, because they're very nimble, they supply cheap inputs to big business and make high profits in the corporate world possible. They felt that this new GST was hostile to their very existence, that the GST was encouraging businesses to have relationships only with businesses above the registration threshold, which indeed it was. This was a way by which businesses were being coerced to come into the GST net. So many of these small businesses shut shop. Then after about 3 months of this disastrous experience, the compliance architecture was softened a great deal. And so we now still have that softer compliance architecture in place. But the damage had been done. And small businesses, even those that might have opened up again after compliance softened, nevertheless see the GST as hostile to their existence. And even though, as I said, some of those who shut shop might have reopened again, there has generally been a reluctance among other potential entrants into small business, into actually entering to small business and facing what they see as harassment at the hands of the GST authorities. So although this has not been a major contributing factor to the slowdown of the Indian economy, which has been happening for 8 successive quarters before COVID, nevertheless, it did make its contribution. And therefore, notwithstanding slide 4 of Michael's presentation, VAT need not be growth enabling. It can actually be growth retarding if the pace at which small businesses are brought into the tax net is accelerated to the point where the GST is seen as hostile to small business. So the first lesson coming out of the Indian experience is that a VAT should not be entered into in a state of high revenue anxiety. A period of at least 3 years should be given over which revenues can be built up, and compliance and entry into the tax net can be encouraged in a non-hostile way, by encouraging small businesses to see the advantages to themselves of registering in the tax net.
Indira, I don't want to interrupt you, but I promise to give you a 1-minute warning.
Okay, thank you. I appreciate it. So that's one lesson. The second lesson from the Indian experience is that tax evasion, even in the presence of a very demanding compliance architecture, remains a great problem. We've had a number of firms which have been busted, which were selling input tax credit receipts. So there have been a lot of fake input tax receipts which have been claimed as for refunds. The problem of discouraging evasion has been there. And one reason, I think, has been that prior to the GST, we did not have a good back office setup which could have analyzed the tax returns and worked out norms and benchmarks specific to each sector of what percentage of input tax credit would be appropriate for that sector. Finally, if I just have half a minute left, let me speak positively of an innovation which India introduced, which I think has been a very good innovation, but it hasn't been carried through all the way. What was done 2 years ago was that an electronic system of monitoring all transportation of goods by rail and road was introduced. It's called an e-way bill. And this is a unique electronic 12-digit number that is given to each consignment of goods above a certain value threshold by road or rail, specifying who the sender is and who the recipient is. This was designed as a check on evasion. It has functioned remarkably well in the sense that this platform on which these data are being collected is functioning well. It has generated a lot of data. In fact, this is the best high-frequency indicator we have of growth in the Indian economy right now. But inexplicably, even though this was set up in order to check evasion, the e-way bill platform has not been merged with the GST platform. So it is not as though the data on these consignments of goods are being routinely fed into the GST network in order to check on input tax credits. So this is inexplicable. There is a promise that these two will be merged. I think one of the problems has been that the GST network was originally outsourced to a private company, a very well-known company, but they messed up big time. And that was one of the big problems that the GST had, that the platform was crashing periodically. Whereas the e-way bill was set up with a government platform, which has worked very well. So in this case, the public sector platform has actually worked much better than the private sector platform. I'll stop here.
Thank you so much. That was rich and fascinating. And now for a different experience, I'm just going to turn to Nicolas, who's going to talk to us about the Benin experience of the VAT, a different sort of country to the very enormous federal India. So Nicolas, I'm just going to turn over to you, and I will take the liberty of letting you know when you have a minute left as well. Thanks.
Merci beaucoup. Je voudrais remercier tous les participants et principalement le FMI pour avoir organisé ce webinaire sur la TVA. Le Bénin a une longue expérience en matière de TVA, bien qu'il soit un petit pays de l'Afrique de l'Ouest. La TVA a été instituée chez nous en 1991 avec un taux unique de 18%. Et bien entendu, nous avons maintenu ce taux de 18% depuis lors. Nous avons résisté depuis toujours à la tentation d'avoir plusieurs taux, ce qui est rare en Afrique. Nous avons un seuil d'assujettissement à la TVA qui est de 50 millions de francs CFA, soit 76 000 euros. Et nous avons bien entendu un système de remboursement de TVA qui aujourd'hui est basé sur le niveau de civisme fiscal. Les entreprises qui sont à risque faible peuvent obtenir le remboursement de leur TVA, de leur crédit de TVA dans un délai d'1 mois sans contrôle préalable. Donc les entreprises sont classées par civisme fiscal risque faible, risque moyen et risque élevé. L'avènement de la TVA au Bénin a énormément joué sur notre organisation administrative qui était fondée sur le service des contributions directes et le service des contributions indirectes. Et tout ça a changé très rapidement avec la TVA, de sorte que nous avons intégré dans l'organisation administrative les fonctions fiscales depuis 1998 et nous avons réussi à faire une segmentation de notre population fiscale qui est désormais organisée en petites entreprises, moyennes entreprises et grandes entreprises. Et à ce titre, nous avons créé la direction des grandes entreprises en 1991 et ceci bien avant la France. Et après, nous avons créé progressivement des centres des moyennes entreprises. Les recettes fiscales, aujourd'hui en matière de TVA, représentent 41% de l'ensemble des recettes fiscales du Bénin, soit 4,4% du PIB. Ces dernières années, nos recettes de TVA ont énormément connu une augmentation. Par exemple, en 2018 par rapport à 2017, nous avons connu un accroissement exceptionnel de 26,6% de la TVA, soit 0,4% du PIB. Et ceci est dû à la principale réforme introduite sur les factures normalisées avec l'utilisation pour les entreprises d'une caisse enregistreuse. Nous avons également mis en place des réformes de télédéclaration et de télépaiement des impôts. Donc aujourd'hui, la TVA en ligne au Bénin. Nous avons également réussi à mettre en place une interconnexion, une plateforme d'échange de données entre, d'une part, la douane, les impôts et le budget. De sorte que si les entreprises ne sont pas sur cette plateforme, vous ne pouvez pas faire une importation, vous ne pouvez pas engager un marché public. Il y a eu également des réformes de politique fiscale, notamment le réaménagement de la taxation des micro et petites entreprises, qui a eu un impact sur, bien entendu, la TVA, et on a procédé à la réduction de plusieurs exonérations qui existaient. La dernière suppression, c'est avec la loi de finances 2020 où nous avons supprimé les exonérations qui existaient en matière de TVA sur les ordinateurs et les logiciels. Je pourrais également vous dire que en 2019, notre TVA a connu malheureusement un repli en matière de recettes fiscales. On a connu une diminution des recettes de 10% environ, et cela est dû à la fermeture de la frontière terrestre entre le Bénin et le Nigeria voisin qui se trouve à l'est. Bien entendu, le Bénin commerce beaucoup avec le Nigeria. Cela a joué sur nos recettes. Et c'est parce que les réformes que nous avons engagées ont permis d'améliorer la situation. Sinon, le choc serait beaucoup plus important par rapport à cette fermeture des frontières. On a noté que le potentiel fiscal en matière de TVA au Bénin est encore inexploité ou est partiellement exploité. En effet, dans un rapport récent du FMI où on a utilisé la méthode holistique, on a constaté que nous avons un gap de TVA estimé à 4,4%. Donc, on est en train de travailler actuellement pour déterminer le gap par secteur d'activité. Le Bénin a été identifié comme le Rwanda parmi 5 pays du monde pour utiliser les recettes additionnelles de la TVA pour financer les objectifs de développement durable. Et nous y attelons. C'est pour ça que nous avons 2 défis actuellement pour améliorer les recettes de TVA. Le premier défi, c'est la digitalisation. On a déjà implémenté en tant que premier pays de l'Afrique francophone les caisses enregistreuses avec un système de facture normalisé. Nous voulons dématérialiser ce système pour aboutir à une déclaration pré-remplie en matière de TVA dans les années à venir. Et le deuxième défi, c'est de renforcer la capacité de nos ressources humaines et de nos contribuables parce que la TVA demeure encore un impôt très complexe pour nos États africains. Je voudrais terminer en remerciant le Fonds monétaire international à travers le département des finances publiques pour son appui constant dans l'assistance technique au niveau de notre administration fiscale. Merci à vous tous.
Nicolas, thank you so much. That's a very interesting take, a very interesting tour through Benin's experience. So we've certainly had a wide variety here. We've had the European Union, India, and Benin, thus following up on Mick's initial talk, showing that VAT is adopted in and works in all sorts of different economies. I'd just like to close very briefly. I want to close by thanking certainly all the panelists and Mick for their valuable contributions to the discussion. I especially want to thank everybody for literally hundreds of people have been listening to this, and I want to thank you all for being there, and especially thank you for your insightful interventions and questions. That's exactly what we had hoped would happen, the idea to have a lively intervention, set of interventions. And again, I'm just going to try to close very quickly. Mick gave us an overview of the last few decades of the VAT rather quickly. I think the main thing we see about from that is that VAT is indeed, as we've been calling it, the workhorse of the tax system. And now that's true all across levels of development, from the most advanced countries to the poorest and more recently developing countries. So there are certainly, VAT, I believe, is with us for the long haul, but there are a lot of new issues and issues that have never been fully resolved in the past. There are policy issues that can relate to both policy and administration, like the digital economy and financial sector, which I was asking Patrice about. There are issues in countries with subnational governments, which we heard about from the Indian perspective, and in a different way, a different sort of federation from the EU perspective. There are issues for developing countries who have introduced the VAT more recently. We heard from Nicolas about the Benin experience, and then a couple of an intervention with respect to Rwanda as well. Rebecca gave us a pretty good overview of where the academic work has been going on the VAT. And then these were all enriched and enlivened by your questions. And I think there's a set of topics that have come out in the Q&A and that we'll try to drill down to in our future webinars. A lot of discussion about the ideal of trying to hold to principles, the principles that underlie the VAT versus the political realities in some countries. As we heard from Indira, India, with extremely widespread poor population, it changes the situation from, as Rebecca was saying, a country like New Zealand, which has a very highly literate, small homogeneous population. There are major differences and challenges in the position of developed countries and developing countries. How to address the challenges of large informal sectors. I think we talked about that a bit, depending on what one means by informal, but in the case of developing countries, I think what was being referred to was small traders, perhaps even illiterate traders. So that certainly raises issues that we addressed a bit. As we just heard again, many are concerned, rightly, about the issue of either the reality or the perception of the VAT impact on progressivity. It's been very, as Mick said and others have said, one can't really look at that without looking at the whole tax system and indeed the whole tax and expenditure system. As speakers have said, the VAT is raising a lot of revenue that can be used, if expended correctly, either directly to support people or ideally to work on the most important sustainable development goals that have an impact, a great impact on the poor, education, health. But I think our panelists did raise the problems of how to make sure that actually happens. And that's what Susanna, I think, was alluding to at the very end in her intervention. There's a VAT challenge for African countries with digitalization, but also digitalization is helping to facilitate administration and compliance. Benin is an illustration of that. Lots of challenges for small businesses, lots of challenges remain with the financial sector, and some discussion about incentives. And I think we can sum up Mick's view by saying, don't do it. That's not the right way to, as is perhaps the case with trying to help the poor through the VAT, it's not the way to help industry either. That's not what the VAT is for, but this clearly, I think, has made me at least look forward to the next set of webinars where a lot of these issues will be discussed. We very much hope to see you all there again, and hope that you found this as useful as I found it. Really, I think a good summary of our history with the VAT for the last 3 decades, the world's history. And again, just in closing, I want to thank the funders of our Revenue Trust Fund who made this possible, our bilateral donors, and certainly I want to thank our members of our outside panel, Rebecca, Patrice, Nicholas, and Indira, for taking the time to be with us and provide us with their insights this morning. So if we were in person, I'd ask for a round of applause, but since we aren't, I'll simply bid you farewell. Have a good rest of your day or your night or wherever, whatever time it may be, wherever you're listening from. And thanks very much to everybody, and we'll now sign off. So thanks.
We hope you found the interventions instructive and useful. In our next podcast episodes, we will be sharing the presentations from the webinar. Thank you for joining us in this episode of the TADAT videocast. We hope to see you in our next episode. Stay tuned.
TADAT is a collaborative undertaking of the following partners: France, Germany, the International Monetary Fund, Japan, the Netherlands, Norway, Switzerland, the United Kingdom, and the World Bank.